All right. Good afternoon, everybody. So we're getting ready to go here. It's a beautiful day outside, and I am going to start sharing my screen here. And let me start. I'm going to sort of switch back and forth. Well, I'm going to just show my entire screen. So here's where we're at. Here's where we're at. And I put our week 11 lecture discussion here. I'm going to spend quite a bit of time on week 11 outline here. So I'm going to bring that up now so you can follow along there. So here it is. And let me go to the very top. We're going to start here. Here's our outline for the day. Notes on the midterm. We're going to talk about the asset tracking. We're going to talk about alternative assets, cryptocurrencies, and then project and homework. So we're going to start with notes on the midterm. And Enrique, can you provide an update where we're at on the midterm?
Yeah, so we had some issues, we don't know what, but a couple of people didn't I mean, they submitted, but the answers weren't recorded. So if you didn't receive any email, that means that you're good. Your scores are there and graded, actually. But because of that, we are waiting on everyone to complete it to release the grades. Okay. So if you didn't receive anything from us, means that you're okay. If you did, you probably already took the text again or whatever that you needed to. Uh, so yeah, I guess that's it. But besides that small issue, everyone else is graded. I think the grade was the average was good. We're gonna be talking about that next week, but everyone was good. So yeah, I think that's it.
So if you got any questions on the midterm, let us know. Let me get the chat box up here so I can see if you put something in the chat box. All right, there we go. So if you got any questions on the midterm, but we're not going to talk about it till next week because we just had a little snafu with the grading. And again, for whatever reason, some people took the exam and it didn't record. And if you didn't receive an email from us, you don't have an issue. So, all right. So now we've taken midterm 2 is done, and we have 3 things left to do in this course. Well, you have a homework that's due next week, and we'll talk about that today. You have a project due that we're going to talk about today. So that project grade, and that project won't be done till after the break, and then we have a final. So we're going to begin focusing on on the project today. And if you want to think about what we're going to be doing in the last part of the course, is so far we've talked about stocks and equities. So we've gotten a pretty good feel for those stock and equity investments. We've talked about bonds and that part of the investment. We're going to talk about alternatives. So in most cases and most portfolios, stocks, equities, and debt will correspond most of the assets. But there are cases for putting alternative assets into a portfolio, real estate rates, cryptocurrencies, and we're also going to broaden that discussion a little bit and talk about reasons to put small cap bond or stocks into a currency, and also foreign assets are international stocks within a portfolio as well. So we're going to talk about those things. and that is what we're going to spend most of our time on the remainder of the course talking about. So that's what we're up to. So now let's move to the asset tracking. So asset tracking this week, we had 3509 was the ending of the week. Stock S&P 500, that was a 7.32% increase. Hey, Enrique, what has it done today? Could you tell me what the S&P 500 is today? It's
Oh
been
yeah. So far it's minus 1%.
okay.
Yep.
So we've had a increase last week of 7.3%. That happens to be the biggest weekly increase during our semester. That is a pretty good increase. What news did you just type in your chat box? What news did you tell us happened this week on the S&P 500? We're gonna just make some news here. News this week. What did you say happened? Yeah. Yeah. Well, all right. You thank you both. You hit two of the major ones. One is the election, and Cam said split Congress and vaccine news. All right. Anything else that we want to put here? Anything else that we had? Yeah. Anybody else want to add to that? So here's a question. Why do you think split Congress caused the market to rise? And so just to recap here, what happened, or it appears what has happened, is that House is still controlled by the Democrats. Yep. No massive tax increase. Right. That's exactly right. The House is controlled by the Democrats. The Democrats actually lost seats in the House. The Democrats or the Republicans retain control of the Senate with less of a margin. It looks like the Senate will be 51 seats Republican, 49 seats Democrats, and it looks like Biden won the presidency. So you have divided government again, and a Democrat. If what could have happened, or what some in the market were concerned about, is if the Democrats controlled the presidency in both branches of government, we could have seen large changes in government policy. We could have seen tax increases or changes in tax. We could have seen more Supreme Court justices. We could have seen a lot of things. Work on climate change, etc. You may be personally for or against that, and where you come out on that is your political views. But I'll tell you right now, the market doesn't like massive changes, and anytime you begin to think about making changes in taxes, healthcare, etc., what you typically see is that S&P 500, that volatility index going up, or the VIX going up, and just simply concerns about that. So the government, or the assets, the sector was, I guess I would say, comforted by the election results. We have split government, and for better or for worse, we're likely not to see major changes over the next time period. Again, how you view that is obviously your your political views. I put up here 2 articles. All right, so you can look at these articles, and they both mention the same thing you did. I want to point to one of those, though. I'm going to go here to this one. I'm going to pull the stock market, and I want to bring something down. So this stock's finished best week since April. 2020 elections, blockbuster stretch with, and then obviously the vaccine. But I want to keep going down here. All right, here we've talked about this. Yields on corporate. This is a sentence that was interesting, and we just got done with the bond market, so it plays into what we've talked about it. Yields on corporate investment grade debt have dropped this week as bond prices have risen. So what the market is saying there and why it dropped is a good question. Part of it's the election results. Part of it is probably the vaccine, but we've seen the risk. If you're looking at these two things, this bond price drop, yields have fallen. We're saying risk premium has dropped. So the market is saying there's probably less of a chance of recession and less of a chance of default on those corporate debts. So this is corporate investment grade. So this would be corporation. Meanwhile, oops, something happened there. I don't know what I did. Oops, I'm sorry. I hit something. Let me go back. I apologize. I don't know what happened. Let me keep going down. Oops, I went too far. Meanwhile, prices on municipal bonds issued by state and local governments have swung as the prospect that would have helped crushed by have grown murkier. All right, so if you're looking at some of the impacts on COVID-19 and the control measures, it's really going to have a high and large impact on state governments and municipal governments. There was a considerable amount of hope that if the Democrats won both houses and the presidency, that there would be a fairly, as this says, a giant package. So there was some expectations of a very large package to help state and local governments make up the shortfalls that's likely to happen because tax revenues will be down. All right, tax revenues to Illinois, Chicago, and it's not just Illinois and Chicago, it's every state, every municipality come down. There is a larger chance of a default on those debt instruments. So, as we're looking at those municipal debt bonds, a lot of those municipal bonds, the prices went down, which meant the yields went up. So something to watch here. And so if you're thinking about, if you were in the financial planning arena now, you might be thinking about, if I have these muni bonds, which are tax exempt, I might be a little bit skittish of those, particularly if I'm looking at some states that have some issues there. All right. By the way, AMC, we looked at that last week. AMC bond, Henrique, what happened to that? That went up, right? We had a large increase on that.
Yeah, there was the AMC like stock, right?
Yeah.
But yeah, it's a little bit down today, but I think earlier this week it went up like 50% or something.
Yep.
Still down though, but...
Yep. So the outlook according to the market, has gotten much better for AMC, at least as far as its debt levels are concerned. So we'll stop there with our asset tracking. But again, so as you're leaving this class, you'll be you'll be following this, right? You will be following this. No, you'll understand. All right, you should be following the markets, and you'll understand their impacts on these different investments. We have a comment here. I don't know if this is still the case, but isn't Illinois state debt in terms of bond just above junk status? And yes, bond ratings for Illinois are very low. CCC, close to junk status. There's large concerns with Illinois debt and the ability for Illinois to make its debt payments in the future. There are actually 3 states where you have large concerns immediately. And that would be Illinois, New York, and California. There is some thought, though, that every state will, those 3 are at the head of the pack, so to speak. And that a lot of the concerns with Illinois and those states revolve around the retirement plans. And just backing up a little bit, retirements of employees in the state of Illinois until very recently was a defined benefit plan. I actually am not on a defined benefit plan. I took the money and made my own investments, which was the opportunity I had when I came here to the University of Illinois. But other people said, I want the defined benefit, which is you get, if you work 30 years, you get X percent of your salary as a pension. Well, to fund that X percent of salary as a pension, presumably the Illinois was putting enough investments away to make that happen. And all the pensions in Illinois, and there's a lot of concerns in every state, but Illinois, New York, and several others have more concerns than others, that there's not enough money or not enough invested to make the pension plans payments. And what's Illinois going to do? It can either not fund the pensions, not fund the debt payments, or not fund current obligations. So we'll see where that all plays out. But that's sort of the concern now with state and local governments. So related to you, my guess is none of you will ever see a defined benefit plan. You will have to make contributions to your retirement, whether that's so like now, if you're at the University of Illinois or any state government, you're a new employee, you make investments in a retirement plan that you control, or you can dictate amongst certain amounts of assets where you can make those investments. That's the wave of the future, because you don't have the issues now like Illinois has. All right. Alternative assets. We're going to talk about one today, and you're going to have some modules on some more. So so if you're thinking about it, again, coming back, you're putting together a portfolio. Portfolios typically include stocks, equity investments, and bonds, debt instruments, fixed assets, fixed income amounts. There are a host of other assets as well. Those include real estate, cryptocurrencies, and I'm sort of lumping in here other mutual funds and ETFs as well. So Enrique we're going to start with a discussion of cryptocurrencies here. So I'm going to stop sharing the screen, and Enrique is going to take us away.
Let me just quickly share that. There's the share button. Oops. Yeah, sure. Are you guys seeing my screen here?
I got them.
Okay, cool. Close that. Yep. Okay. So we've been talking about investments in general. We talked about early in the class equities, right? Stocks, and then equity funds. Then we moved on the second part, talking about bonds or fixed income and bond funds as well. Now, you should have, I think, everything you know in order to put those in a portfolio, but we're going to be talking more about it. And there are other classes of assets that you might also think on having in your portfolio. And one of them that I'm going briefly to introduce you guys is cryptocurrencies. Probably you guys have heard about Bitcoin, at least, uh, which is the main one. But I want to give you just a sense of what is a cryptocurrency, like just an introduction, and what are the main pros and cons that people talk about when considering investing in cryptocurrencies. Okay, so I'm gonna, as I said, it's just like an introduction here. So cryptocurrency, I think a good way for you to think about it, let's leave aside any technical issue. Think about a currency. So you could buy euros and have euros with you, right? You can buy this cryptocurrency, which, as the name says, is think about it as a piece of code, okay, that you want and that has value. You can change it with dollars or euros as a currency, okay? A main distinction of the cryptocurrencies and other currencies is that it's not issued by the government, all right? So there is this whole system, usually they use blockchain system, that is a decentralized network that has to approve each code in the network. And so you can either mine those codes to find it, let's say, or it's already with investors. So it's finite as well. So a good way to think about it, it's a currency that is not government issued. It's controlled by whole network, so it's a very huge network, which you might be part of that, and it has this strict ledger system, which makes it very safe from the standpoint that every transaction it's highly traceable. Okay. Now there are several examples of cryptocurrencies. I think the most famous, as I said, is Bitcoin, and it is the oldest and also the largest, the one that is traded the most nowadays. Okay, you see the market cap here. You see Bitcoin is the one that is mostly traded nowadays, but there are several others. Okay. Now on this screenshot, one Bitcoin was trading on $15,000. So think about as a currency, okay? At that moment, maybe $1 was worth in, I don't know, 0.9, 0.8, I don't know, euros. And one Bitcoin, it's worth $15,000. Now, you don't have to buy one entire Bitcoin. You can buy like 0.0000 something of a cryptocurrency, but it's just for you to get a sense of examples of cryptocurrencies, and you can find more over here, okay? Now, a few of the pros and cons of having it in your portfolio as an investment. This is just a few. You probably can find way more cons and way more pros as well. But one of the pros that people argue is that it's that aspect of that is non-issued by any government. So supposedly you have immunity against government. So if government decides to, I don't know, monetary policies might change and such, because it's not government issued, Bitcoin will be kind of like immune to that. So there are people that argue that that could be a possible inflation protector. I'm not gonna go into that, but it's just one of the aspects, not being government controlled, that people argue pro a cryptocurrencies in general here. Okay. Another one that we're going to be seeing in a few, it's the low correlation with markets. So we're going to see that it's not, it's actually low correlated with markets in general, which if you think about putting together in a portfolio, if you believe the markets are efficient, remember, it's all about returns, standard deviations or risk, and correlation between assets, right? If you have two assets that are have a low correlation, you have the diversification benefit. And supposedly here, historically, actually, cryptocurrencies have a low correlation that could provide you diversification benefits with equities and bonds, or especially equities here that we're going to look at. Supposedly, it's easier to transact compared to other exchange rates. And there's a question mark here, has delivered higher returns than the market in the past years. But we're going to be looking at that in a few moments. Now, the cons of that, I think the biggest issue here is that uncertainty about regulation and therefore taxes as well. So there is a list, if you guys go here on this website here, there's an article summarizing how is nowadays cryptocurrency regulated across the world. And you can find specifically on the US as well here. I believe in the US right now, it's state, so states, each state has its own regulation on cryptocurrencies. So yeah, you'll find more information about it. But the point here is it's still very uncertain if all countries, there are some countries that ban cryptocurrencies. So how would that be taxed in the future? So it's not clear yet. And that uncertainty is definitely something that you should consider, right? Now, another one that goes with that is about its adoption in the future. If it's not regulated, will people adopt it, right? Or it's just a bubble, let's say here, and eventually people will not have it anymore because it's not worth it. So there's a lot of uncertainty yet, but it's growing, its adoption, but there's still a lot of uncertainty. And one other major con here is with those supposedly high returns, you're going to see, but there's massive volatility compared to equities. And so if you think that bonds supposed to be fixed income, very low risk, equity you would see as risky, cryptocurrencies are another level of risk. So you're going to see the standard deviation here, and it's massive in some cases. So you got to be careful when putting that in your portfolio, okay? And just one more here, although the code is very secure, the network, the piece of code is very secured, and where you keep those is not in a bank. So there's still security issues related to where you keep your cryptocurrencies, because maybe hackers can go into your wallet and steal it, right? So with that, let's dig a little bit on the historical performance on a couple of cryptocurrencies here. This is Bitcoin. I think it started in 2009, if I'm not mistaken, but I have here Yahoo Finance data from 2014 to nowadays. And what you see here on the graph, this green that looks like a straight line, this is S&P 500, or it's the Vanguard index fund on the S&P 500. And you see that it looks like a straight line. So this small thing here is COVID. So the volatility you can tell here on the Bitcoin makes equities looks like there's no volatility at all. And you can see that here on the standard deviation analyzed here. Although if you look from the beginning, cryptocurrency, especially in this case, Bitcoin, it still deliver a high Sharpe ratio, right? Higher Sharpe ratio comparing to the market. But this is one case. There's a lot of cryptocurrencies and not all of them did as good as Bitcoin, okay? Now, if we look here at, if you started with $1 investing here in July of 2017, so 17 because we don't have much data. A lot of those other cryptocurrencies are kind of new, so we don't have a huge historic performance as S&P 500 or other equities or bonds. We see that it's, again, highly volatile. So comparing here to the equities or S&P 500, you see a huge standard deviation risk, but some of them, and Bitcoin especially here, delivers like positive Sharpe ratio yet. But now let's pretend that instead of starting investing $1 in July of 2017, that would have gains here eventually. You started here in January of 2018. So there's another completely different picture. So you are still exposed to that volatilities, but you missed that huge jump here in the beginning. In that case, they actually didn't deliver positive Sharpe ratio. So when you adjust those returns by its risk, you would have a better risk reward ratio in some other investments. So you got to be very careful when using cryptocurrency. I think this is the message. Okay. Now, during that period of time, if you look at correlation with S&P 500, the darker it gets here, the lower the correlation. And you can tell here that, so let's look here, S&P 500 and those cryptocurrencies, this is Bitcoin, it's going to be somewhere 0.3, 0.4 maybe. This is very low. I mean, you can find possibly even lower correlations, but you can argue that it would provide in a portfolio some diversification benefits, okay? That's according to its short but historical performance, okay? Now, if you're looking at putting everything in a portfolio, again, let's say that you believe that markets are efficient and you're trying to make this efficient portfolio, everything that you need is returns, right? And when you look at cryptocurrencies, okay, historically, Bitcoin delivered high returns, but will they persist? So we have this uncertainty about regulation, taxes, and the future adoption. So are you gonna use the same historical returns to put that in a portfolio? That's gonna have to be your call, but that's something to consider. Be careful with the high volatility. So remember, usually high volatility and risk brings more returns, but you might want to limit your exposure to cryptocurrencies given its high volatility. Maybe you can add just a little bit in the portfolio to give some diversification and returns, but be careful with this high volatility, right? And finally, goes with that, it has low correlation with US market, so you might have some diversification benefits when putting that in a portfolio. And to analyze it in a portfolio, it's pretty much like we did on the homeworks. We did on midterm 1, I think. You have returns, standard deviations, correlation. You can play with those, remember, and solve for the EV frontier. And then you will find out the expected returns and volatility of the portfolio given the weights of those assets. All right. So this is an introduction to cryptocurrencies. There's a ton of materials for you guys to look online, but it's just so you know that there are other assets or the classes of assets other than equities and bonds in the market. Okay. So I don't know if you guys have any questions or comments here. If not, yeah, if not, I think Gary, you can have it back.
All right, thanks. So how many, do you own cryptocurrencies, Enrique? I shouldn't ask.
I do a bit, yeah.
A little bit.
It's very small part of the portfolio, I would
Low
say.
part of the portfolio.
Yeah. It's, yeah.
So no, how'd you buy it?
Well, there is some bunch of websites that you can, it's pretty much you open an investment account kind of and buy it, and transact it. You can transact it. I think there is already some websites sort of like, I'm not sure if that particular, but Alibaba or other like kind of like Amazon marketplaces that accept already Bitcoin as currencies, as a currency. But that's not why I use it, it's just, to get this exposure to that as well,
Yep. All right. So we're going to move on here. I'm going to show you, bringing you back to my screen again. Let me get back to here. All right, let me go back to my, so we've done the crypto. Now we're going to talk about our project. And I'm going to say, we're going to go walk through our project file, which is on our website. This is on our website, and I want you to, we're going to talk through this. We also had a couple modules this week that talked through the project. So you got that, you got the project file, and let me just go through here. All right, here is the project. Zoom this to the page width. So Enrique, is that big? Can you see that? Did I make this?
Yeah, no, that's good. Yeah.
All right, good. So we got the entire screen up here. And let me just set this up. This is a real live, you're going to put a real live portfolio together, and it's for you. All right. So we're going to put a portfolio together. It is your portfolio. And here's the idea. In less than, some of you less than 6 months, some of you a little over a year and a half, some of you somewhere in between there, you're going to be out in the workforce. At that point in time, I would suggest you do one thing, and you might be forced to do this, but one thing: start a retirement plan immediately. And I'll indicate why that is. But if you start a retirement plan now, there is a very good chance that you will have enough funds at your retirement to live comfortably. The longer you wait to do that, the more difficult it is going to be to generate enough funds to retire comfortably. All right, so this is life, real life for you. And by the way, if you work for certain companies, they will have a 401k where they make a contribution, and then you have to make a division of those funds into various funds that are available. Some of those I used to have, for example, when I was at the Illinois, I used to have Fidelity, or that they're not available. I still am at the Illinois, but you know, you could choose to invest in Fidelity mutual funds. So even if you're not, you will have, if you're working for certain corporations, you will have a defined benefit contribution plan, and you can make the decisions of where you put that money in. So this if you do this well, this should prepare you well to make your decisions. And if you're going to be a financial planner, one of the fundamental things financial planners do is set up retirement portfolios for their customers. There's a lot of other things, but almost always looking at retirement is one of the key things that people do. All right, this project, if you want a review on it, you can submit it for a review at any time, but if we get it in by December 4th, I will provide a review for it, and the final due date for this is December 9th. All right, and let me go to the website here. Where you would do that is, here's the project. Here is the project description that we're looking at. If you want to submit it for a review, submit it right here, and I will review it. I ask that you submit it through here because emails get lost for me. So this is one way to keep track of things. And then the final project is here to do it December 9th at midnight. So you'll submit both of these right here under this project tab. All right. So coming back here, what you will be doing is determining. So I'm going to tell you, you're going to invest $400 per month. And again, that's something that you will have to decide. $400 a month I think is a good number. And that would be $4,800 a year. All right. I want you to pick 2 assets for your portfolio. All right. So you're going to put 2 assets into that portfolio. You can, and let me rephrase that again, at least 2. I want more than 1, at least 2. And you could do more. You could put 3, you could put 4, you could put 5, but at least 2. And I want you to start with this as the model. You don't have to do this, but use this as your model. Use this as the benchmark, and then talk your way away from it. And as you're talking your way away from it, give me the reasons why you're moving away from it. So, all right. Your benchmark portfolio is a 75% stock, 25% bond portfolio. All right, so 75% of it would be in a stock index fund, and we'll come back to that, and 25% in a bond fund. Okay, again, you can deviate from this model. Well, that's not set in stone. You can deviate from this, but here's, let's say, and again, let's say you decide you wanted 100% stock in portfolio, which is perfectly good, and I would actually probably encourage that. That would give you higher returns and higher risk. Okay, nothing wrong with that. So when you're thinking about this 100% returns and risk, you would say, I want more return and risk, and that's why I'm investing 100% of my assets in a stock portfolio. All right, and then we say that if you're more returns oriented, or you want more returns, you will hold more stock, and vice versa. Okay, I would also suggest holding mutual funds and other ETFs in this portfolio, but you don't have to. You could start out and say, I want to invest in, I don't know, Google, Alphabet, actually, Alphabet. I'm gonna hitch my star to Alphabet. Here's your problem, or here's the issue that you have to confront when you do that. You have just bet your retirement on one company. And over the long run, you probably don't want to do that. So you could start out your portfolio with one company, but over time you would want to add more stocks to that. Okay. All right. Any good investment books to read? That's a good question. Yes, there are. And I'm going to put together a list, and we will get that together. What books have you read, by the way? You said you already read them. If you wouldn't mind, just indicate what you've been looking at. But we will put together, that's good. We will put.
There's Warren Buffett's essays.
Yeah.
That's good.
Yeah, Warren Buffett. All right, Warren Buffett is obviously very good. Anything Warren Buffett says is worth reading. Warren Buffett would be, so he would be a value investor. So he would not totally agree that the markets are efficient, but he acts. If you look at his strategies, it's buy and hold, buy and hold, buy and hold. So he keeps his costs low, and he invests in things that many people don't think are all that wouldn't be investing in. So, for example, railroad, but he's very good. Yes, he's very, very good. And I'll put together a longer list of those. That's good. One thing that I would ask you to do, Enrique just mentioned this, a random walk down Wall Street. And so a random walk down Wall Street would say you can't beat the market. It's an efficient market. So invest in the efficient market. It's good to read that book though, because even if you don't totally agree with that the markets are efficient, there's some very important things you can learn from the concept of market efficiency. One is that if there are inefficiencies, they probably don't last forever. Number two, costs aren't critical. Cost and keeping those costs low are absolutely critical to long-term success of a portfolio investment. Excellent points. When you're putting your portfolios together, don't use the Vanguard 500 Index Fund or the Vanguard Long-Term Treasury Fund. And it's not that those are bad investments, it's that I am going to use those as examples. So take away half your work. Actually, if you want the Vanguard 500 Index Fund, which is a S&P 500 Index Fund, choose Spartan 500 Index Fund, or practically every investment company has a 500 Index Fund that will perform pretty much like Vanguard 500's Index Fund. Anything written by John Bogle is worth reading too. So John Bogle would be another good person to read from. I'm going to pick a couple of non-investment, non-market efficiency people for you to read as well. The other one, again, Vanguard Long-Term Treasury Fund. We're using it as an example in class. I'm going to actually write the exam. I'm going to give you an example of the what I'm looking for next week on the project using those two funds. So don't copy me. All right. All right. Here's what you're going to do. You're going to describe your assets. So you're going to take your two assets, and this can be done in a couple paragraphs. And think about you're going to describe this to your client, or, so you're going to get straight to the point. Here's my two assets. And if you're having equity, you're going to tell me, and I picked those things from our mutual fund comparison sheet: value versus growth, small cap versus large cap, active versus passive. So those sorts of things give me the objective of the fund and some assessment of its risk. Variability, betas, CVs, Sharpe ratio, all right? If it's a debt instrument, you're going to tell me what type it is: Treasury, corporate, muni, tip. It might be a combination of those. Credit quality, inflation protection, and tax exemption. So those sort of things, and give me an assessment of risk as well. Then you're going to do a section on show historical return, standard deviation, and correlation coefficients. So you're going to do what we did, what we're going to do for the homework this week, and what you've done in any one of a number of times. You're going to put together returns and standard deviations using historical data that you got from Yahoo Finance. By the way, so I know that you can get that data by looking at historical returns. There is a really important point of doing this with the returns itself, and that is you really should be looking at this correlation coefficient. You should be looking at how the two assets that you're putting together are correlated. And if you pick two risky assets, for example, if you pick two stock funds that are risky, it isn't necessarily all. Well, let me give you an example. You pick two. Let me give you an extreme example. You pick Vanguard 500, which you can, and Spartan 500, which is exactly the same thing as Vanguard 500. Their correlation coefficients are going to be 1, maybe 0.9999. you have accomplished nothing by putting that portfolio together because they're so highly correlated that you're not getting any benefit. All right, so that's one of the reasons why we want to look at these correlation coefficients. And a lot of what you should be doing when you're looking at somebody's portfolio is thinking about how to complement that portfolio with something that will change its returns and risk, but also probably you want something with as low a correlation coefficient as you possibly can with what else is going on. You're going to show me an EV frontier from of those assets. If you got a two asset model, you can use that spreadsheet we used before. You could do, if you're using 3 or more, you would have to do something like we did in the we've done it before with our EV frontier. You're going to describe your rationale for the assets and investment split. Here you're going to tell me, all right, I picked a mutual fund, a stock mutual fund that's more risky than the 500 index fund. I want higher risk, I want higher returns, and I'm picking an investment split that causes my portfolio to be more risky than the 75-25% split. All right, estimate an expected return and variation on the portfolio when you retire after 40 years, and we'll discuss more of that in the class in the next couple classes. And assume you're going to hold your investment for 40 years. So if you're 21 now, maybe 21, 22, 40 years, you'll be 61, 62. Okay. Then finally, what should you be concerned about in this portfolio? What are its risks? And here's what we're looking at is think through, you made a portfolio investment, what could make that not turn out to be a good thing? Okay. So that's our charge. Questions or comments here about that? Clear as mud? Sort of know what you're thinking about? All right. All right. So that's what we're looking at. Now, let me go back. All right, we're coming. All right, I am going to pull this spreadsheet down right here. So we're going to pull this down right now. And you have this available. This, by the way, was what was used to do the modules as well. And I'm going to show you. Oops. Here we go. This is what you should see. Let me blow this up. All right. So this, you should be, this, we've done this before, but this is what we should be looking at for our coming up with our returns and risk assessment for the project. And you have an assignment that we're going to use to do this for this week as well. So let me go through this. We have Vanguard 500 Index Fund, VFINX here. I have it from, let me zoom this up a little bit, make it a little bigger. I have this going back from 10/28/91, which is the beginning point of this fund. So when you're doing your analysis for your two funds, I would suggest going back as far as you can. And I'm going to talk next week. Let's say you pick a fund that only has 1 year of data, which there's a lot of funds out there. What do you do in that case? And we'll talk about that as we're going through. This one, I pulled it down to earlier this week, I guess, maybe last week. So 11:30, so we're pretty current. I calculate the returns as we always would. This is daily data, so it did the means, geo means, which I still can't spell. And I used our formula over here. So beginning minus end. Here's it in, oops, I'm sorry. Here it is in daily returns. And then we put it over here. We annualized it. So those are the annual returns. And then this is the question. Actually, this is a question you got on your on your homework. Calculate the means, standard deviations, 9.8, and I'm using the geo mean here. 18.4. So if we're looking at this as a coefficient of variation of all right, what's gonna format cell number 2. It's at 1.88. This one has 0.90, just like you would expect. And here's the big deal. It has minus 0.22 correlation. All right, again. So let me tell you, to get those correlations that low, one of the things that you're going to have to do is pick some assets that are pretty different. It will be very seldom that you get two stock funds with that low of a correlation. I then calculated an expected return here for a portfolio that has weight of 0 on FF or stock index fund, which will need 100% on our treasury fund. So this will be exactly the same returns as this. This will be the opposite. So I could graph that, and then I would have an EV frontier, right? I can make this much more coarse. And I did this, I wrote the formulas. You wouldn't necessarily have to do that. You could use one of our previous spreadsheets that you looked at it from a 2-asset portfolio module. All right, let me show you. I'm going to zoom this up some more. All right, so if I put a portfolio together of 100% stock index fund using that historical period as a guide, I would have a 9.8% average return and 18.4% standard deviation. All right, your model portfolio is 0.75, and we'll come back to that a little bit. That would have an 8.7% return and 13.6% standard deviation. All right, I want to show you the difference that will have in 40 years. All right, so if you tab over to this future value sheet, future value here is fairly easy to calculate with we're using the future value function in Excel. And the future value function in Excel, you put the rate, the number of periods, and the payment. And the payment is the per yearly input. So we're putting in I told you we're going to put $400 into this portfolio. Okay. So here, and now I'm going to make this 75% VFINX. So I'm going to bring this return from here over here. All right, so I told you this. You're going to make a $400 investment. By the way, that's your choice, but $400 investment. this is if I make 100% VFINX investment, I have an annual return of 9.8%. I reverse the flow and calculate the monthly return like we did practically the first week of the course. And this 480 periods is 40 years, 12 periods. So if I invest a 9.8% return at the end of 40 years, my expected, let me write this, expected future value, because some years I'm not going to get as much, some years I'm going to get less than that, is $2,100,000. Okay. That, if I do this investment, is 1.5 million or $500,000 less. All right, that's significant, right? So that, and by the way, just so we get the assumptions right here, this is, you make a $400 investment, you get that expected value each period or annualized period. You're not changing the portfolio as you're moving through time. You're not making it less risky, okay? Or more risky. And same thing here, you're keeping it more or less risky, all right? And here then is your expected future value. So I got, I'm sorry, one in my chat box up here. All right. Let me get my chat box. I got a question. I am going to change this from 480 to 20 years. Let me just put this. So that's exactly the same. So now these two numbers are exactly the same. This is 480. Oh, yeah, I will. Thanks, Enrique. Thank you. Is that better? I don't know if I can make it bigger.
Yeah, no, that's better. You can make it bigger, but okay, better. Otherwise, then that's okay.
Let me see if I can get up bigger. Let go. Ah, you did.
Yep, perfect.
Perfect. All right, here's my question. All right, you got a lot of things to do in your life, and you got a lot of demands for your investment. What happens to this number here, this 2.19 million, if I wait 20 years? So I'm only going to do 20 years rather than 40 years. So you're going to start your portfolio, retirement portfolio, when you're 41 rather than when you're 21. How much lower do you think this number is going to be? You're going to wait 20 years. You think it's 75% of that number? Type it in. I'm just please do this for me. Just play my reindeer game. Is this number going to be 25%, 75%, 50%? So what do you think it is? Again, set this up rather than start next year. And Ben, you're a smart man, or you've done it already. Yep, Ben's close to right. So you wait till this equals 20 years times 12. It's lower than you, 13%. All right, that's the power of compounding, and that's why we really, where I'm saying really do it now, because if you do it next year, it will be much easier to get to your retirement goals, all right, than waiting even 10 years. All right. And that's the power of compounding, because we're gonna start that $200 you invest, or $400 you invest next year, has 40 years to grow, and that really makes a big difference on this ending number. Now let me show you even if you don't do, oh, I keep doing this, I'm sorry. Even if you don't do this at 280 and or this one at 400, you do it at 200, you can still see 1.5 million. You still, if you do it half, you still got a extremely or much more significant. So $200 a month, $400 a month. If you get $2.1 million by the time you retire at 61, you'll be able to say, you won't be extremely wealthy, but you'll be able to say, I don't want to work anymore. All right. All right. I'm done. Take this job and shove it. All right. So do it next year. All right. I want to do one other thing here. And so, all right, just to give you a feel here, if you had $2.1 million, how long are you going to live in retirement? And I'm going to say you're going to live 30 years. So if you're 61, you're 71, 81, 91. So I'm going to take you to 91. That's 30 years. You're going to get this 9.8% return. You're not going to make it any less risky. And you can calculate the payment that would need to be made. So this is using the payment function. But if I have $2.1 million, this is the reverse of the loan, right? $2.1 million. I want to make a payment. I want a payment out of that every year for 30 years, 9.8% return. I would generate $219,000. All right. Let me again just do this over here. Oops. I'm going to leave. We're not going to play with that 9.8%. Although if you did, let's say you did choose to make it less risky. Oops, 0.007. You still get you can see there that oops, 0.7%, not 0.07. So even if you do make it less risky, that's still $169,000. That's still a good amount. Again, you got to build in some inflation expectations here as well. But let me just show you. You don't do that. You do that for 20 years. You'd be living on $29,000. All right. So that'll give you a feel. So that sort of framework there is there. And we'll, again, got questions on that, but that's sort of what you're thinking about. It doesn't include risk, and we'll talk about that next time. All right, questions or comments on that while I get back to my outline. And I keep losing the chat box. All right, so let's just summarize the retirement. We're looking at a retirement portfolio. There's others, but again, see the project. Diversification is the key. Long investment time, and one other thing is there's important tax implications to these investments. Most of your investments, you have two sorts of tax benefits that you can have. One, and which is most commonly used, is that you pay taxes on the money going in, but you pay no taxes on the earnings while it's in the portfolio. So it's not taxed until you withdraw it. That is a very important item to think about, because you typically think of your highest investment or your tax rate being when you're in the 40s or 50s and 60s, when you have the highest earning potential. We have marginal tax rates that increase were progressive taxes. So if you get that, that is something to consider. I personally did something called a Roth IRA, which means I didn't defer the taxes when I put it in there. So I got both. Roth IRA, which is you pay the taxes and then you don't have to pay the taxes on the income when it comes out, which we'll see how that works out. All right, so here's where we're at though. Here's, now I want to just touch on our basic, our basic Boggles recommendation is our stock index fund, Vanguard 500, 1 minus your age. So I'm saying you're 25. And the intermediate and short-term fund is the age is your weight. So that's where those numbers come from. It's John Boggles' recommendations. And this is a very plain vanilla investment strategy. All right. Here's, you can think about this if you do exercises or strength training. There's a minimalist, you know, where you only do 2 exercises, but you pick the 2 exercises that have the most bang for the buck. That's this portfolio. There's no frills, but it gets you a lot of bang for the buck. Now, where we're going from here is you can add more to this, and we'll talk about what you can add to this. But we can add certain things. We can add more. We can make it more risky and more return or expected return. We can lower the risk and lower the expected return. We can have some active managed in there. We can put our cryptocurrencies in there, and we can add some diversification as well. All right. We'll talk about those as we go through the week. All right. There is a homework due next Tuesday. There is an asset tracking, and you now have a look at the project. And again, I would say take this seriously and think through this, and this will help you next year. Questions or comments before we turn her off this week? I don't know. Who does Illinois play this week? Is there a possibility that Illinois football will win? I don't even know who they play. No. Who do they play? Does anybody know who? Oh, Rutgers. Yeah, no, I don't know. You're probably right. All right. We will see you next week. So have a good week, all.
Hey Gary, I don't know. You want to stop recording? You had a meeting like a couple of minutes. Do you want